Welcome back to Chapter 2 of our series, Invest Your First $1,000. In today's episode, titled Risk Explained, Why the Stock Market Always Goes Up Long-Term, with Nuances, we're going to unpack the vital relationship between risk and reward in investing. By the end of this episode, you'll have a clearer understanding of how to navigate these concepts as you embark on your investment journey. Let's dive in. The stock market has crashed by more than a third, and your account is deep in red. Yet history says this might be the moment your future returns quietly start compounding. How can something that feels so bad now be the main reason long-term investors end up ahead? A red portfolio can feel like a verdict, but it's often just a snapshot taken in the noisiest part of the story. To see what's really happening, you have to zoom out from your account balance and look at the machine behind those numbers. Real businesses solving real problems, hiring people, raising prices, cutting costs, and constantly fighting not to be left behind. Indexes quietly reshuffle in the background. Weak companies drop out, stronger ones take their place. So the scoreboard you're watching today won't look the same 10 or 20 years from now. That churn is not a bug. It's the mechanism that channels human effort, innovation, and capital into the most productive uses over time. In this episode, we'll unpack why that messy process has historically pushed markets higher over long stretches, and why always goes up still comes with serious fine print. Markets don't drift upward because they're nice. They rise because investors demand payment for stomaching uncertainty. That payment has a name: the equity risk premium, and it only exists because the ride can be brutal and unpredictable. When you buy stocks, you're effectively saying, I'll accept scary headlines, recessions, and deep drawdowns in exchange for a shot at higher long-term growth than cash or bonds. Some decades, that bargain feels genius. Other times, it feels like a mistake for years on end. The nuance is learning which risks are temporary noise and which can permanently change a market's trajectory. Here's the uncomfortable core of equity investing. Most of the reward you see in neat return charts comes from a handful of really ugly, stressful periods that you only recognize as opportunities in hindsight. Look at the numbers. In US data, shrinking your lens to 1 year looks like a coin flip with bias, roughly 3 winning years for every losing one. Zoom to 20-year stretches, and historically, every single one has been positive for broad US stocks. But that always hides gut-wrenching journeys inside. Some 20-year windows included a 50% crash, a lost decade, or multiple recessions. Long-term positivity and brutal short-term pain are not contradictions. They're partners. Why does the long run tilt upward? 3 engines. First, earnings. Over time, companies raise prices, expand globally, automate, and find new lines of business. The S&P 500 in 1980 had giants like Exxon and IBM. Today, Apple, Microsoft, and Nvidia dominate. The index quietly swaps yesterday's winners for tomorrow's. So you're not betting that one company survives. You're owning a moving portfolio of whatever is currently most profitable. Second, dividends and buybacks. Cash paid out and reinvested isn't flashy, but it's powerful. Historically, a big chunk of total return has come from taking that steady cash drip and plowing it back into more shares when they're cheap. That's why 2 investors with identical funds but different habits, one reinvests, one spends the income, can end up with wildly different outcomes. Third, valuation resets. Periodic crashes don't just hurt, they reset prices to levels that can support stronger future returns. The early 1980s, 2009, and even 2020 all opened the door to higher subsequent gains precisely because fear had marked prices down. But there are limits. Japan's Nikkei is the warning label. If you invest in a single country at bubble valuations, you can be underwater for decades. Demographics, policy mistakes, and starting prices all matter. Global diversification isn't a buzzword. It's how you avoid anchoring your entire future to one economic story. So the nuanced truth is this. Broad, diversified equity markets tend to grind higher over long spans. Not because losses stop happening, but because the system repeatedly reallocates capital toward what's working, while punishing anyone who demands comfort on a short clock. Think of two friends who each invest in a broad stock fund at age 25. Alex adds money steadily through every scary headline. Jordan pauses contributions whenever news feels bad, and piles in only once markets feel safe again. They own the same fund, yet Alex usually ends up with far more, not because of superior stock picking, but because more of their dollars were deployed when prices were temporarily marked down by fear. You can see the same thing at the company level. In 2001, Amazon looked like a broken .com. In 2008, banks looked untouchable in the wrong way. In 2020, airlines and hotels felt doomed. Broad indexes don't argue with that mood. They simply rebalance over time, shrinking exposure to business models that truly can't adapt, and growing exposure to those that prove resilient. A bit like medicine adjusting treatments as symptoms change, markets constantly re-weight which businesses get capital. Your job isn't to predict every shift, it's to stay exposed to the process long enough for those shifts to work in your favor. Long-run upward drift doesn't mean your path will match history's smooth averages. As demographics, climate policy, and AI reshape profit pools, returns may arrive in sharper bursts, with longer flat spots between them. Think of sectors rotating under a spotlight. Healthcare glows as populations age, then energy or semiconductors step forward. The implication? Diversify across regions and themes, and expect leadership to change more often than headlines suggest. So instead of asking, will it go up this year? Start asking, what mix of markets lets me stay in the game long enough for history to matter? That shifts focus from prediction to design, like arranging shelves so they won't topple when you're not home. The goal isn't comfort every month, it's building a setup that survives many different futures. Try this experiment. Open a paper trading account, or use a small, fixed amount of real money you're willing to lose, and create 2 mini portfolios today. One all-in S&P 500 index fund, and one stock picker portfolio of 5 individual companies you think will beat the market. Commit to adding the same dollar amount to both portfolios on the same day every month for the next 6 months, no matter what the market is doing. Track how you feel each month: temptation to time the market, fear during drops, excitement during spikes, and jot those reactions right next to the performance numbers. At the end of 6 months, compare which portfolio performed better and which one was easier to emotionally stick with, and decide what that teaches you about long-term, risk-adjusted investing. This was Owl Up, your daily step forward. To keep learning with structured courses and more insights, go to owlup.co. Until tomorrow!